Welcome to the deep dive. Today we're digging into Vera Bradley, ticker VRA. They just reported their Q2 fiscal 2026 numbers pre-market on September 11th. And well, if you follow this company, you know it's right in the middle of a huge strategic shift. They've divested Pura Vida, focusing everything back on the core Vera Bradley brand. It's a big transformation effort.
Oh, absolutely. And I'd say transformation might be putting it mildly. It feels more like a trial by fire based on this Q2 call.
Yeah.
We get these really sharply mixed signals. Management did a great job on cost control, no doubt. But then you look at the sales numbers. Well, they confirmed what the market was worried about. Sales are shrinking and fast.
Yeah, that immediate stock drop, like 10% pre-market, tells you exactly where investors' heads were at, doesn't it?
It really does. They zeroed right in on that top line weakness.
Okay, so let's unpack those headline numbers. Because like you said, that contrast is really the story here. Bottom line versus top line. First, the good news, I guess, the EPS beat. Non-GAAP loss was only 2 cents a share, negative 0.02 cents. The street expected a 15-cent loss.
Right. Negative 17 cents was the consensus. So beating that by 13 cents, that's significant. It definitely shows they've got a handle on spending. Real discipline there.
But then, boom, the revenue number, that kind of wiped out the good feeling, didn't it?
It really did. Revenue came in at $70.9 million. Consensus was looking for more like $78.5 million. So a decent miss there.
And the year-over-year comparison, ouch.
Yeah, that's the kicker. Down 24.6% compared to last year. That's a substantial drop. And what's really fascinating, or maybe telling, is how the market reacted. Ignored the EPS beat, ignored the cost control success, and just hammered the stock on that revenue miss.
So the message is clear. Investors are less worried about today's profit, more about whether the brand has long-term legs if sales keep falling like this.
Exactly. Cost cuts are great, but they only get you so far, right? You can't cut your way to growth forever. Eventually, you need demand, structural demand.
Which puts enormous pressure on the next few quarters.
Okay, let's drill down a bit. Where did those sales declines actually hit? The direct segment, first, that's their stores and e-commerce. Revenue there was $60.5 million, still down 16.2% year over year.
And the driver, comp sales. Comparable sales dropped a massive 17.3%. That tells you people just weren't buying as much, whether they were in a store or online. Conversion was the problem.
17% down is bad, but the indirect segment, the wholesale business, that was even worse, wasn't it?
Oh, it was a bloodbath. Indirect revenue absolutely plunged, down 52.5%, just $10.3 million for the quarter.
52.5%. Wow. That's more than just key accounts trimming orders, surely. You have to think so. A drop that steep, it suggests something more structural is happening. Maybe wholesale partners are losing faith, cutting back shelf space significantly, or just clearing out VRA inventory altogether. It raises big questions about their long-term distribution.
Okay, so with sales under that much pressure, how reliable was that EPS beat? Was it just, smoke and mirrors with inventory, or were the cost savings real?
It seems like it was mostly real cost savings, actually. The gross margin held up surprisingly well at 50.1%.
Yeah.
That was actually up about 600 basis points from Q1.
Sequentially. Okay.
Yeah, and management said part of that improvement came from selling less stuff through deep liquidation channels. So the merchandise, that's the balancing act, isn't it? You have to wonder.
Let's look at the balance sheet, too. How are they holding up financially through all this? Cash was $15.2 million at quarter end.
Right. And they did manage to cut inventory, which is good, down 13.2% year over year to about $96.7 million. That helps free up some working capital eventually.
But there was a flag there, too, wasn't there? Something about the ABL.
Ah, yes. The crucial detail. They drew down $10 million on their $75 million asset-based lending facility, their ABL.
Okay. And for listeners, drawing on an ABL basically means?
It basically means they need a quick cash injection. It usually points to working capital pressure, likely stemming directly from that big drop in sales. It's a sign the balance sheet is under some strain. Needs careful watching.
Which brings us to the turnaround plan. Because with that kind of pressure, the strategy isn't just important, it's like absolutely critical.
It's their lifeline. Management spent a lot of time on this. You have the Strategy and Transformation Committee, Executive Chairman Ian Bickley really spearheading things.
And first up, leadership. Still searching for a permanent CEO, right?
That's right. The nationwide search is ongoing. But in the meantime, they tried to offer some proof points that the current plan is working. Specifically, they mentions sequential improvement in comp sales each month during Q2.
Sequential improvement. So things got less bad as the quarter went on.
Essentially, yes. And they said that trend is continuing into Q3. That's vital. It suggests maybe, just maybe, they've found a bottom even if the year-over-year numbers still look pretty grim.
And they pointed to some product wins too. Leaning into the brand's heritage seems to be working.
Definitely. Things like bringing back the classic Vera tote. The licensed stuff seems popular too. Disney, Peanuts collections did well.
But the standout example had to be that Gilmore Girls capsule collection.
Oh, absolutely. Sold out in about 5 minutes, they said. 5 minutes. That's not just a fluke. It shows when they hit that intersection of heritage and, a relevant cultural moment, the demand is intense. There's still passion for the brand out there.
So they're trying to build on that momentum. The next big launch is the 100 bag.
Yep, the Heritage 100 bag. It's an icon they're reissuing, priced under $100, launching October 2nd. And they're tying it into a campaign with the Radio City Rockettes, who are also celebrating 100 years.
That's actually pretty clever marketing, tying two nostalgic American brands together.
It is. And this product focus connects to the bigger operational changes they're making, those 5 strategic initiatives. 2 seem really key right now.
Okay, what are they?
First is Omni Channel cohesion, basically making the experience seamless between online and outlet stores, like running the exact same promotions in both places.
To stop confusing customers and maybe help margins too.
Exactly. Reduce friction, stop people abandoning their carts because the deals don't match up. Simple stuff, but important.
And the second one, something about outlets, Outlet 2.0.
Right. Outlet 2.0. This is a big one. Right now, their outlets are mostly just for deep discounts, right? Which kind of hurts the main brand's image over time.
Yeah, I can feel like a clearance bin sometimes.
So this Outlet 2.0 pilot, which they're running over the holidays, is trying to change that, make it a nicer, more joyful experience, they said. And crucially, they're going to test selling some select full-price items in the outlets.
Full price in an outlet. Interesting. Trying to capture better margins and elevate the brand perception there?
That's the idea. Stop the race to the bottom on discounting and see if they can make the outlet a more positive brand touchpoint. It's a pilot, but if it works, it could be significant.
Okay, so lots of moving parts in this turnaround. What does it all mean looking ahead? The elephant in the room on the call was guidance.
Yeah, the big question. And the answer was no specific financial guidance for the rest of the year.
No guidance? Why not?
They cited the ongoing transformation, everything we just talked about, and also the dynamic consumer environment. Basically, things are too uncertain for them to commit to numbers right now.
That lack of visibility, especially with sales falling so sharply, can't be good for investor confidence, can it? Makes it really hard to model things out.
Definitely weighs on the stock. And the external picture isn't helping either. I mean, look at the market. The S&P 500, even the retail ETF XRT, they're up nicely year over year.
Yeah, XRT is up, what, over 20%?
Around 21, 22%, yeah. Meanwhile, VRA is down almost 50% over the same period. Massive underperformance.
And they still have headwinds like tariffs, too.
Yep, they estimate about an $11 million annual hit from tariffs. Their sourcing teams are working on ways to mitigate that, but it's another challenge.
So if you're tracking this, the things to watch are purely about execution then?
Absolutely. It boils down to, does that 100 bag launch on October 2nd actually move the needle? Do we see any improvement in inventory turns? They're aiming for improvement over the next, 12 to 18 months. That's a long time.
And the CEO search, that's got to be huge.
Paramount. They need someone who can come in and convince the market, and especially those wholesale partners, that they can stop the bleeding in that indirect channel.
Okay. Before we wrap up, it's time for our segment. This is not financial advice, where we toss out a, let's say, creative trade idea based on everything we've heard.
Right. And given the stock's wild ride after the call, volume was 4 times the average and how low the valuation seems, this is definitely playing in the narrative space. It's a bet on execution against very low expectations.
So what's the outrageous but plausible pitch?
Okay, here it is. High risk, obviously. You're looking at buying deep out-of-the-money call options, maybe expiring sometime after the holiday results are clear, so think Q4 earnings or early Q1 2027 reporting.
Deep OTM calls, that's a leverage bet on a big move up. What's the catalyst?
It hinges on one of 2 surprise announcements that completely flip the script. Option 1. Management comes out with concrete, positive data from that Outlet 2.0 pilot showing it's really working, driving conversion, boosting margins, a genuine game changer for that channel. Option 2, They announce a new CEO who is a total rock star, someone with a stellar track record, maybe from a much larger successful retailer who the market instantly believes can fix that wholesale mess.
So you're basically betting that the Gilmore Girls sellout wasn't a one-off, that they can actually translate that social media buzz they tripled TikTok followers, right, into real sales.
Precisely. Can they bottle that lightning? Can the heritage product refresh actually stabilize things in Q3 and Q4? The current stock price and volatility are basically pricing in failure. This trade bets on a surprise success, even if it's just a temporary one driven by one of those specific catalysts.
A true binary bet on management pulling a rabbit out of the hat. Okay, let's bring it home. Final summary on VRA's Q2. It was definitely a mixed bag. Impressive cost control, no doubt. And you see these little glimmers of hope in the product strategy leaning into heritage. But wow, that revenue shortfall just looms large, and it's clear this turnaround is a multi-quarter marathon, not a sprint.
Yeah. The final provocative thought I'd leave folks with is this. Markets often overreact in a crisis. That sell-off was brutal. But remember, that sequential improvement in comps they mentioned, month over month within Q2.
Right. Things maybe stop getting worse.
Exactly. It suggests a potential bottom might be forming internally. The huge question now is, can that fragile internal momentum, those product wins, actually overcome the macro environment and start rebuilding trust? Especially with that critical wholesale channel. Can they turn those TikTok views into actual store traffic and sales? That's what you need to watch.
Excellent points to consider. All right, that's our deep dive on Vera Bradley's Q2. Thanks for tuning in. And just a reminder, everything discussed here is for informational purposes only. Definitely do your own research before making any investment decisions. We'll catch you on the next deep dive.